Hi there and welcome to the Modern Firm Practices Show. This week we're looking at pricing. This is such a big issue in professional services, especially with accountants with their pricing. There's such an opportunity there to get it right where you are so undercharging below what is, I guess, the retail and the median price. It is not funny. So the biggest thing I see is most firms, they're just too cheap and they're putting their prices up maybe every year. A lot of them haven't put them up for ages, but incremental, but you're already this far away from probably the middle of the line, very far away from, let's say the higher bracket if it's more of a commoditized type service. So this not only applies to hourly rates, which is still, I would say, this isn't based on statistics or survey results, but I would say most firms are still charging by the hour, but plenty more conversation and plenty more are moving to a different alternate type of pricing. But whether it's hourly rates or it's some type of fixed fee structure, especially with very common commoditized tax type services like an individual tax return in Australia, in the USA, a W-2 type tax return, it's a race to the bottom. You can drive around the suburbs and see that there's practitioners pricing these types of services at ridiculous prices, like $70 or $80 per return Australian dollars. When we look at this pricing and we look at it overall, a lot of firms are scared to put their price up for a number of reasons. They don't want to upset the apple cart. They don't want to upset clients. They don't want to deal with confrontation. Pricing is almost, there's so much going on in the business. Pricing is almost like second or third or fourth down the line. This is how we price. We just don't think about it. That's just how we do it. But there's a lot of opportunity there. So if we look at, hopefully you can see green on the screen. We're talking here hourly rates. This is going to apply to fixed fee pricing as well. But if we looked at a firm doing $1 million and they put their price up by 10%. A lot of you are probably putting your price up 3 to 5% every year, but let's just work off the number of 10%. Most partners would probably say, if we put our price up by 10%, okay, we're going to lose clients. But let's keep in mind, you are already making quite poor margins compared to what you could be. And you're running around with so many clients to look after, so many team members to look after, and so many things to do in running the business. It's just not funny. But you won't entertain the idea of that for 10 seconds. Okay, so let's look at that. $1 million revenue. You put your price up by 10%. Let's keep the maths easy. Okay, I don't want to work up a sweat here. That's an extra $100,000 a year. And if your ITR or your W-2, you charge, let's say, $250, then you can afford for 400 of them to say, no, I don't want to pay that 10% increase. I'm going to go elsewhere. So you can lose 400 of your tire kicking clients. This is a worst case scenario here. Based on the numbers, you could lose 400, which means you put the price up. Hypothetically, your revenue goes from $1 million to 1.1, but 400 of them crack it and leave. So instead of it going from $1 million up to 1.1, it stays at $1 million, but you have 400 less individual low margin jobs to now look after. Not only that, but all the administration that goes around those 400 particular people, where I'm sure there's a truckload of scope stretch going on there. And don't worry, I've got that, on the list, which we'll get to in a moment. But can you see here, just on that very basic maths, okay? All of your accountants, you can do that. That's very simple. That's the opportunity cost that's sitting there. But you also deserve better, okay? I want you to raise your standards. You've also got too much whip, because that's, I guess, how hourly rates work. You hit the clock, you time to buy an hourly rate, and at the end of the month, you go, oh, we can only bill this, but we can't bill that. Why? Based on what assumption? Well, we just bill at the end. Okay, well, no. You have previously billed at the end. Why can't that be changed? Why can't there be an interim bill? Why can't it just be billed at the end of every month? Why can't it be billed at the end of every week? These are all things, there is no ironclad agreement with what you have to or don't do. And do a lot of people in the industry do it like this? Yes, but it doesn't have to be like that for you. You can choose your own adventure here, okay? I love that sort of philosophy of choose your own pricing adventure. How do you want to do it in your firm? And who cares how other firms are doing it? That's their choice. It's none of your business. So, on whip, because I'm not just going to let that slide out the door. Get it built out. I've got a guy that I work with, and when he came on board, his lockup, which for those of you that don't know, lockup is the calculation of all your whip days and your debtor days added together. So what are our days in whip and what are our average debtor days? And for him, it was 180. And this is a firm doing about 800 grand. So it's not far off this number here. And he definitely needs to put his prices up, which we'll get to in a sec. And 180 in lockup, half the year. So if he started the job today, what are we, the start of July? The first week of July, okay? If he started the job today, and even if he finished it, I don't know, at the end of the month, he wouldn't get paid on average until January next year. That is madness. So, whip, get it out the door if you're going to stick with this type of structure. I think I could do 100 modern firm practice weekly videos on different segments under pricing. But there's a great opportunity there. A lot of firms, I mentioned earlier, they're scared to get scared to try a different pricing method, even though this may not be the most effective for them, even though they might be have a much less margin, and the opportunity cost there of having a higher margin is simply having a little bit of courage to put their price up, because they're assuming that their clients won't respond to it really well. What your clients aren't going to respond to really well is getting surprise bills and surprise changes. So one of the keys to it, of many, but one of the keys is to over communicate what is going on and why we're doing it and how it's going to affect you, Mr. and Mrs. Client. As opposed to, we'll just put our price up. We might send one email about it, which, let's be honest, not everyone opens or reads. And then they get a bill, and what are they going to do? They're going to compare it to last year, especially if it's just a once a year type client. And go, hang on, why are you doing the same thing but charging me more? Now you've got to not only deal with that conflict, and they're already upset, so we now need to address that. It's time out of your day to talk to all of these clients about something that could have been handled a lot differently. So a lot of you are scared of trying something different because of the what if happens. This, though, is based on, again, when we look at what's going on, especially with hourly rate pricing, and don't get me wrong, a lot of you are doing fixed fee pricing wrong as well. And I will say it myself, I have done hourly rate and fixed fee pricing wrong as well. So I know what it's like to be in there. Is that you're already got a truckload of scope stretch and a truckload of write-offs. So you're saying, oh no, we couldn't change or we couldn't put the price up, but we're doing all this work and not billing for it. And we're, even of the work that we do bill, we're then writing a whole lot of it off. So you're saying this works, but then you're saying we also do that. tell me in what world does that make any sense? That brings us to the next point here, which is scope stretch. What's scope stretch? There's a couple of ways you could describe it. There's been the word scope, creep, scope, seep, bracket. Someone said to me yesterday, bracket creep. They all mean the same thing. We've got a particular job or project that we're working on. We've scoped out, here's what we're going to do and here's the deliverables. And either here's our price, or we're just going to hit the clock and charge an hourly rate for it. So the way we get scope stretch is two ways. You just do more work than what has been scoped. And the reason you would do that is the client might just ask for more and you just do it. And you don't bring up anything. And you might not even hit the clock for it. Or you do, but then you write it off anyway. If it's a fixed fee job, more importantly, you don't stop and say, hey, this is actually outside of the scope. So the client is piling on more. Another example would be you do the job and you find things along the way. This will be the most common. Okay, so you start the job, you find that the books are horrendously messy. Okay, why? Probably because the client does their own bookkeeping. You all know what that's like. Why should you wear the scope stretch and wear the write-offs because of that? None of it's your fault. So the client adds more on, you just fix things that you find. Probably the two most common. And one more actually would be you are inefficient at what you do. So you've got a lack of tech, you've got a lack of process and systems, you maybe have a lack of team training. That's on you. You need to wear that one. But the great thing with it is you can fix it. There's so much tech going around now, it's not funny to streamline any different part of operations. What else did we have? Process. I know most firms don't have processes in place, but you can build out your own. I'll be honest, it's not super exciting. It's the lowest on my list, but you can get people to come in and help. And it could even just be something short term. Otherwise, there's suppliers that can supply things like processes and checklists and working papers and portals and workflows for a really reasonable subscription fee, which means you don't even have to think about it. You can just plug that exactly in. And if it's team training, that should be something that is budgeted for in the business. Do we need help with business development? How do we train our team on these, better running these advisory services? You're very good at learning more of the technical tax stuff. That's not your problem. And you're going to find under the modern firm practices conceptual framework and the things I'm going to be talking about, I'm not going to be talking about technical tax items, because you are the pros at it. That's the thing that you're the best at. But that, if we look at the E-Myth, okay, some of the things spoken about in that great book, being an amazing, a technician doesn't automatically mean you're an amazing business owner, business manager, good at sales, marketing, research and development, and so on. So scope stretch, how do we address scope stretch? We do it through an additional work order. What does that mean? I'm going to explain this to you through a different industry. Okay, this is a separate topic altogether, but different industries can learn so much by looking at other industries and seeing what they're doing. You'll see most industries, everyone, and the majority of them, they all do the same thing. Why? Because they just all follow each other and look at what everyone's doing. So it's called an additional work order. I think it comes from the construction industry. And it essentially is, if you're, let's say I've scoped out a job to rebuild someone's kitchen, and we build it all and we price it all up and do everything, and it's 20 grand. And we go in there and we rip all the kitchen out. And when we do that, we find that they've got termites. Now, if I'm the builder, there's two directions I can go in here. And the builder's only ever going to take one direction. But this metaphor works perfectly. I can just go and fix all of the termites. Okay, I don't tell the client about it. I just go and do it. It's going to take us heaps more hours. We're going to have to probably buy some more materials because we're going to have to knock additional stuff out and put fresh things in there and spray it with some termite-proof stuff. Okay, you can tell I know nothing about construction, but conceptually is probably what happens. And I wear all of that. I don't say anything to the client. I rebuild the kitchen. The client has no idea they had termites, but they get the kitchen that they bought. That's what most accountants are doing at the moment. The alternative is I stop the job and I pick up the phone. Here's my trusty phone. And I say to the client, hey, we've got a problem. We've started on the job, but we found this. This is what it means. This is what we need to do. This is how much it's going to cost. Where would you like to go from here? How would you like to proceed? And what's the client going to say? Oh no, just put in the new kitchen and leave the termites. It's as long as I get the new kitchen and the house falls down, that's fine. No, of course they're not. The client's going to go, oh damn, well I didn't budget for that. And the client can't say, why didn't you know this from the start? It's impossible to know. You only found it along the way. But this is exactly what happens with accountants every day, especially on compliance jobs. You start the job, okay, you're pulling the kitchen apart and you find the termites, but you miss this additional work order. So you price up, you go to the client, how would you like to proceed from here? Here's the price. The client's going to say, sure, well, look, the client doesn't have to be happy about it, and they're not going to be. Why? Because no one likes to pay more than they have to, but that's not your problem. So don't take it on. Just step back, present it to the client, and go from there. So the key differentiator there is identifying this is outside of what we should be doing. I'll have a conversation with the client, and we're going to go from there. Write-offs. I know I've mentioned this a couple of times now. Stop it, okay? Why are you doing it? I always like to ask the question why. There's this concept called the Toyota 5 Whys, different video. But peeling back and stopping for a second, why do we do this thing in our firm? Accounting firms have got a great business model, but it is a little bit like Groundhog Day. It's just the same thing over and over and over and over. And we don't stop and start to question things. And write-offs is definitely one of them. So why do we need to do write-offs? Part of it is because we've just mucked up how we budgeted the job. Okay, that happens. I've done that, you've done that, that's just how it is. But the key is learning from it. What did we do wrong? What's the lesson? How do I make sure we don't do that again? Then there's also your, I guess, self-worth, and part of that would also be an assumption. So I'll break that into two. Assumption is, the client probably won't make that. Probably won't pay that. Now that's based on a complete assumption. There's one way to know, and that is that you bill what should be billed to the client, and then you have a discussion around it. But there shouldn't be a surprise for the client. If you're ever getting to the point where you go, this is going to be more than the client thinks it's going to be, you need to pick up the phone and talk to the client right now. It's not going to end well if you just send them an $8,000 bill instead of a $4,000 bill. And they're not going to forget and go, oh, I just presumed it would be 8. No, they think it's going to be 4. Do you think they're going to be happy? No. Okay, but it will be worse if you just send them the surprise bill. The alternative is you wear the write-off, but a lot of the time you shouldn't be budgeting or wearing the write-off because it's not your fault. Okay, there's additional things in the job. The client's made it more difficult. The client wants more done. That's fine. We can do it. And here's the revised fee. A couple more things that are interesting. I'm going to change the color up here just to change things up. Hopefully you can see that on the end there, but it says alternate pricing. What I mean there is alternate pricing models. So different ways of pricing. There's not just hourly rate and fixed fee. There can be a hybrid approach of both. There can be budget-based pricing, ROI, value pricing. I'll get to that next. There can be contingency type pricing. There can be earnout. There's a truckload of different pricing models. Now, lawyers, if there's any lawyers watching this, a lot of legal firms, especially bigger ones, ones in the city, they tend to entertain pricing models and different pricing models a lot more. And yes, they have different types of cases and how they work, but there's no reason accounting firms can't entertain these things. What if you were a specialist in startups? Startups generally have a number of issues. One, they don't have a truckload of cash, but they need a lot of your help. That can be difficult. And what happens? You then end up with scope, stretch, and write-offs because you want to help and you just do additional work and then they can't pay for it, or you don't think they can pay for it, so you write it off. Well, is there an opportunity there to look at an equity type model, or what if we put an accelerator on the pricing? So instead of it being 10 grand, it's going to be 15 grand, but you don't have to pay us for 6 months or 12 months. You can entertain these ideas. I think the reason you don't is because pricing gets put on the back burner. And I think accountants think, oh, well, it's just easy. At the end of the month, I look at the clock, I times it by the hourly rate, and then we're going to write some of it off because of my self-worth, which I don't think I addressed, so I'm going to look back to that, and so on and so forth. So self-worth, to do a little callback, is what you think in your personal world and values and beliefs the job is worth. So you're projecting what you would probably accept and you would probably pay onto this job, not what the client would. And that's a very dangerous and biased approach, because you can do a job and there's a truckload of value in it, and it might be easy for you because you've been an accountant for 20 or 30 years and you know this stuff back to front. Just because it's easy doesn't mean it's valuable. Just because it's easy doesn't mean you can't get paid a lot for it. Just because it's easy doesn't mean the client won't pay you a lot for it. That's your value projection going on it. That happens a lot. A friend of mine, Dave, who's a sales guy, he calls it selling out of your own pocket. Okay, so because essentially when we're looking at pricing, it falls under sales. You're thinking of this as if you're paying for it, and I wouldn't pay 15 grand for this job. I would only pay 9. So let's write off 6 grand and only charge the client 9. That's when we're looking at your self-worth. So plenty of different alternate pricing models that you can entertain, and there's no right or wrong way to go about doing it. Of that, one of them is value pricing. Now, the reason I bring this up is because it definitely was talked about a lot. I'm going to say about 5 years ago, which was around 2015 era, even a little bit before, a little bit after. Value price is essentially the concept of pricing based on the value the client is going to get from it. And that can be both tangible and intangible. So a basic example might be you might do a tax plan for a client, and you might find that they've pulled a whole lot of money out of a company, and in Australia, they're probably going to get in a bit of trouble if they don't deal with that correctly. So you come up with a plan that's going to play in with what they want to do, their investments, future projections, their personal and other investments and so on, that is going to save them, 150 grand in tax, to pick a number. Now, let's say that job took you 3 hours and your hourly rate is $250 an hour. You've just saved a client $150,000 and you're going to hit the clock for 3 hours and bill them $750. So you've just created a value gap of $150,000, and to buy a ticket to the game, that client just has to pay you $750. Whereas from a value pricing perspective, you're taking just a small slice out of the value that you're creating. So if there's a project where you're creating an enormous amount of value for the client, it might be 10% is thrown around a bit. I know it's something I've used quite a bit, some a bit more than that. But of that example would be, well, why couldn't the price for that project be $15,000? So the conversation conceptually with the client goes, we can save you $150,000, and from that you just need to take a small slice, because our fee to put it all together to save you 150 is $15,000. So you make 150, a small slice of that 15 comes to us. Great return. The alternative is you don't do anything and you're going to give another $150,000 to the tax office this year. I don't want you to do that. I don't think you want to do that. I think you should probably speak to a psychologist if you want to do that, because there might be a few wires missing there. That would be more of a value pricing perspective. Now, those jobs like that where you might value price, if you do different alternate pricing structures, there's probably not going to be every single job, but they will pop up, especially specialist tax jobs, mergers and acquisitions, strategic type jobs, growth orientated, maybe even CFO type jobs. There's some people that are strongly for it. There are some people against it. I really love it, but I also know for accountants that they're not going to be able to jump from this traditional type method into this new one. The last area I want to touch is monthly packages. A lot of firms are moving to monthly type fixed fee packages where you're determining how much is the client, what's the scope of work we're going to do for the year, the recurring, the deliverables that the client's going to pay us for the year, and then let's divide that number by 12 and let's start to bill them on a monthly basis. It starts to flatten out our cash flow a little bit. It starts to flatten out their cash flow a little bit. But when you don't properly calculate how much should we be charging the client, and you then don't revisit it on a regular basis, like if you're doing, say, bookkeeping, you might be calculating it based on a number of transactions basis. Well, that can fluctuate, especially in a growing business. So, why would you only review that once a year when after the first quarter, the transactions might have doubled? You're now doing twice the amount of work for the same fee. A little bit of scope stretch there for you. Also with monthly recurring, reviewing back over the year, because there will be some examples, especially if you start to move into it, where you'll bundle things together, you'll come up with a price that you think is going to give us enough margin, we have detailed the scope and the deliverables and the client's happy with it, but things might change, okay? The message, I've said it a number of times, I'll say it again, stop, advise the client what has changed, what it means for them and how much it's going to cost. Now, if you don't do that throughout the year, then that's on you. But when you get to the end of the year, reflect back. And if you've underpriced it and you have to wear that, in some cases you do, then you just have to have that conversation with the client again around, hey, here's how we worked over the past 12 months. And that's a good meeting that you should be having every year, especially with your business clients, is here's how we went, here's some of the projects we did together. You might want to remind them of, hey, remember I saved you 150 grand on tax, and then we restructured your companies, and then I helped you acquire that other company, and then I connected you with that marketer that's just revolutionized your marketing department. And in reflecting back, what we found was that we actually underpriced the services that we delivered. Now, we're not going to do anything about that. That's a win for you, and hey, we're going to have to absorb that cost on our end. But over the next 12 months, to continue with that level and type of service, which we're really enjoying delivering to you, this is what it's going to look like. So again, it just comes back to having the conversation. So a little bit of a modern firm practice show today, and we could talk for a whole day here on pricing. But if you haven't addressed your prices or put your prices up and you know they're below, if I look back to the example I gave you earlier about the client who had lockup of 180 days, for a very common tax return type service here in Australia, he charges about $170 to $180, whereas most other firms would be charging somewhere from the low to mid 200s, and that would be normal. And this particular firm does a large amount of them, and in fact, it's a very common service. I'm not going to go into too much detail, but I just want to show the point where there are concerns and roadblocks around putting prices up, even though they are significantly, I mean to the order of 20 to 30% under what is normal. And so there's no wonder that profit margin then is a little bit tight, because when you look at pricing, okay, we look at a P&L, we all love a P&L. Pricing, what's pricing going to do? It's going to increase top line and increase bottom line. As long as no clients leave, those numbers both are going to jump, which is why it's very dangerous around discounting and taking the approach of being the cheapest. That is the most difficult. The amount of volume and scale you need there, and working capital and so on and so forth, is massive. But we're not going into a low-cost consulting gig here. I just wanted to create some awareness around pricing and the biggest problems. Some things you probably need to focus on. And hey, it's pricing. What's pricing? Pricing is numbers. What are you an expert at? Numbers. You should be able to go through this and pull all your numbers apart. And hey, even being able to collaborate with your peers. I know in our coaching groups, there's heaps of collaboration, especially around pricing. And we help, the rising tide rises all the boats. So there's some boats, especially old mate who's super cheap, who's now realizing, hang on, maybe I should be pricing more, and maybe I can price more, and maybe we are worth it. And hey, if these other guys in the group do it, and they've only been doing accounting for 10 years and I've been doing it for 20 years, I should be probably charging even more than that. And he's 100% right. But it's just getting around that community that's really helped rise it. So I love pricing. It's such a fascinating topic. If you'd like to add some more, if you'd like to agree, if you'd like to disagree, whatever you want, feel free to chuck in the comments.